March 19th, 2003, 6:47 a.m., Birmingham, Alabama. FBI agents surrounded a lakeside mansion, 17 bedrooms, indoor basketball court, $100 million worth of property belonging to one man, Richard Scrushy, CEO of HealthSouth, about to be arrested for the largest healthcare fraud in American history. $2.7 billion. That's billion with a B. Fake earnings, invented profits, fabricated success. 7 years of lies told to Wall Street, shareholders, and employees who trusted him with their retirement savings. But here's the shocking part. Scrushy didn't do it alone. 5 chief financial officers, over 7 years, all participated, all knew, all helped cook the books. How does an entire finance department commit fraud for 7 years? How does nobody stop it? And how did the CEO walk away free while everyone else went to prison? This is HealthSouth. This is the story of how corporate fraud becomes corporate culture and why the person at the top almost never pays. But this isn't just about one company 20 years ago. If you're checking your retirement account right now, any healthcare funds in your 401k or IRA Vanguard Healthcare Fund, Fidelity, Select Healthcare T, Roe Price Health Sciences, or if you own stock in hospital companies, HCA Healthcare, Tenet Healthcare, Universal Health Services, this pattern destroyed $27 billion in 2003. Teachers, nurses, factory workers, people who did everything right. One physical therapist, age 52, 15 years on the job, had $312,000 saved for retirement. 1 week later, $12,000, 96% gone. She'll work till 70 instead of retiring at 62. 8 years of retirement, gone. Let me show you the 5 warning signs that appeared 7 years before HealthSouth collapsed, and which companies show 3 of those signs today. If you have adult children managing their own 401k, especially if they own healthcare stocks, send them this video. They need to see these warning signs. But first, understand the pattern. This wasn't the first time, won't be the last. There's a pattern that repeats whenever one person has unchecked power, and a company's success depends on meeting Wall Street's expectations. Stage 1, the pressure. Miss earnings by a small amount, decide to borrow from next quarter. Stage 2, the escalation. Small fraud becomes normal business practice. Stage 3, the machine. Build a system where everyone participates, nobody questions. Stage 4, the warnings. Auditors notice problems, but company pressures them into silence. Stage 5, the collapse. One whistleblower, one investigation, entire house of cards falls. Enron followed this pattern. Collapsed October 2001. Executives convicted. WorldCom followed this pattern. Collapsed July 2002. $11 billion in fraud. Tyco followed this pattern. Same year. CEO got 25 years. Same pattern. Different names. Same result. In 1996, HealthSouth entered Stage 1. By 2003, they'd reached Stage 5. Let me show you how a company built to help people recover from injuries became a machine designed to deceive. If you remember the 1980s, when healthcare meant family doctors and local hospitals, before it became billion-dollar corporations. You remember when healing was personal, not corporate. Before then, rehab meant physical therapy at a hospital. Small departments, limited services. Healthcare was about care, not quarterly earnings. Richard Scrushy saw opportunity. Born 1952, working class, Alabama. Studied respiratory therapy. Realized something, Medicare paid well for rehabilitation services. Very well. 1984, he founded HealthSouth. The idea was simple. Build specialized rehabilitation hospitals. Focus only on recovery. Stroke patients, accident victims, orthopedic surgery patients. Places where people went after the hospital to regain strength. Brilliant business model. Medicare reimbursed reliably. Aging population needed more rehab services. Scrushy built an empire. By 1986, HealthSouth went public. Stock symbol, HRC. Initial price, $3 per share. Then came the growth. Aggressive expansion. 1 hospital became 10, 10 became 50, 50 became hundreds. Scrushy understood something else. Wall Street loves growth. Show consistent earnings increases every quarter and your stock price soars. Miss 1 quarter? Stock drops 20, 30%. The pressure was relentless. Quarter after quarter, must show growth, must beat expectations. Here's how rehabilitation business works normally. You open hospitals, treat patients, bill Medicare and insurance, collect payment, report actual earnings. Revenue depends on patient volume, reimbursement rates, and operational efficiency. Some quarters better than others. Natural fluctuation. But Scrushy couldn't accept fluctuation, couldn't miss a quarter, built his reputation on consistent growth. Analysts loved him. Stock kept rising. By 1996, HealthSouth operated across America. 250 facilities, 40,000 employees, $4 billion annual revenue. Richard Scrushy became celebrity CEO, appeared on magazine covers, built that lakeside mansion, owned private jets. But behind the scenes, a problem developed. Real earnings weren't matching Wall Street expectations anymore. Competition increased. Now Medicare started cutting reimbursement rates. Growth slowed. Scrushy faced a choice: report real earnings and watch stock collapse, or find another way to meet expectations. He chose fraud, the fatal flaw. Scrushy believed he was untouchable, built a culture of fear and loyalty, surrounded himself with people who wouldn't question, created a system where the CFO's job wasn't managing finances, it was managing fraud. And Wall Street, they wanted to believe, healthcare company helping people recover, what could be safer? This matters because these dynamics, CEO pressure, Wall Street expectations, compliant executives, they didn't disappear after HealthSouth collapsed. Still exist today in corporate America, still create the same temptations. The system that broke wasn't unique to HealthSouth. It's how modern corporations operate when growth becomes more important than truth. The fraud began in 1996, small at first, almost innocent. Weston Smith, chief financial officer, walked into Scrushy's office. Third quarter results were ready. Earnings would miss analyst estimates by about $3 million. Not much. $3 million on $4 billion in revenue, less than 1%. But Scrushy erupted. $3 million short meant stock would drop. Drop meant his compensation fell. His reputation suffered. Unacceptable. Fix it, Scrushy told Smith. Smith understood, not fix the business, fix the numbers. He called his finance team, senior accountants, people who'd been with HealthSouth for years, explained the situation. CEO wants $3 million added to earnings. Where would it come from? Made up. Invented. Fabricated out of nothing. This was the moment, the first temptation, of the decision that set everything in motion. They could have said no, could have resigned, could have reported to the board or auditors. Instead, they added fake entries to the books. $3 million in non-existent revenue, called it fill the gap. Quarter saved, stock stable. Everyone kept their jobs. Scrushy praised Smith, problem solved. But the problem wasn't solved, it metastasized. Next quarter, the gap was larger, $5 million short. Smith filled it again, then $8 million, then $15 million. By 1997, the fraud was systematic. Every quarter, accountants received a number, how much fake earnings needed. They created false entries, inflated asset values, and manipulated contracts to match whatever Scrushy demanded. Let's do the math on early fraud. Real earnings, Q1 1997, $12 million. Wall Street expected $17 million. Gap, $5 million. Accountants manufactured $5 million in fake earnings. How? Simple accounting tricks. Inflated the value of equipment, created fake contracts with inflated revenue, reduced expense accounts, artificially made up numbers to balance the books. That's fraud. Basic fraud. But it worked. Stock stayed strong. Analysts praised HealthSouth's consistency. Nobody questioned how a healthcare company maintained perfect growth despite industry slowdown. This is stage 2. Escalation. Weston Smith, the CFO, realized something terrible. This would never stop. Every quarter needed more fraud. Gap kept growing because they were covering previous fraud plus current shortfalls. He told colleagues, "We're trapped. Can't go back. Can't stop." By 1998, Smith couldn't take the pressure. Resigned as CFO. Did Scrushy stop the fraud? No. He promoted another executive, Aaron Beam, to CFO. Beam had been there since the beginning. Co-founder of HealthSouth, Beam lasted months. Same pressure. Same demands, same fraud. He resigned too. Then came Michael Martin, CFO number 3. He participated, then resigned. Then Bill Owens, CFO number 4. Same pattern, same fraud, same exit. Then Malcolm Tad McVeigh, CFO number 5. 5 CFOs in 7 years. Think about that. Every single one participated in fraud. Every single one eventually couldn't handle the pressure. Every single one left, but none reported the fraud to authorities. Why not? Back when you could trust a company's word? When accountants took professional pride in accuracy? When cooked books was a scandal that destroyed careers, not a calculated strategy? HealthSouth was destroying that trust for an entire generation of investors. Fear. Scrushy created a culture of intimidation, fired people in public meetings, humiliated executives who questioned him, made it clear, you're either loyal or you're gone. Greed. Everyone was making money, stock options, bonuses, high salaries. Why blow the whistle and lose everything? Complicity. Once you participate, you're guilty. Reporting the fraud means admitting your own crime. By 2000, HealthSouth wasn't just missing earnings by millions. They were short by hundreds of millions annually. The fraud had grown so large that accountants worked full-time just maintaining the fake numbers. They created a shadow accounting system. Real books showed true performance. Fake books showed Wall Street what Scrushy wanted. Senior accountants lived double lives, maintaining both sets of records, terrified of making mistakes that would expose the fraud. One accountant later testified, "I knew it was wrong, but I had a mortgage, kids in college. I convinced myself we'd fix it eventually, that Scrushy would find a way to grow into the numbers." They never grew into the numbers. Gap kept widening. If you remember the late 1990s stock market boom, the dot-com bubble, the irrational exuberance, you remember how everyone believed stocks could only go up. HealthSouth rode that wave. Healthcare stock, stable sector, reliable earnings. Investors never imagined the earnings were fiction. Let's do the math on the fraud's escalation. 1996, $3 million fake earnings. 1998, $50 million fake earnings. 2000, $200 million fake earnings. 2002, $500 million fake earnings per year. Total, by 2003, $2.7 billion in fabricated earnings over 7 years. That's not rounding errors. That's not aggressive accounting. That's systematic, deliberate, organized fraud on a massive scale. And here's the key. Earnings were fake, but Scrushy's compensation was real. From fake earnings, Scrushy received salary, $200 million over 7 years, stock sales, $75 million, bonuses tied to fake performance, $50 million, real money, from fake earnings. That's theft. By 2001, HealthSouth's fraud had become a machine, well-oiled, efficient, organized. Here's how the system worked. Every quarter, Scrushy told CFO what Wall Street expected. CFO calculated real earnings. Gap between real and expected went to accounting department. Senior accountants, 5 to 7 people, worked in what they called the family. Only they knew the full scope. Only they accessed both real books and fake books. Step 1, calculate the gap. Step 2, create false entries to fill gap. Step 3, inflate asset values to balance books. Step 4, prepare reports for auditors showing false numbers, money laundering for earnings. With a Fortune 500 company as the washing machine, the fraud required dozens of people, senior accountants, assistant controllers, division CFOs who reported inflated numbers from facilities, IT staff who managed 2 different accounting systems. Everyone participating received something: bonuses, promotions, job security. One accountant received a BMW, another a boat. Small rewards for keeping quiet. But the biggest rewards went to Scrushy. By 2002, his lifestyle was legendary. Not just the lakeside mansion, plural mansions, properties across the country. His primary residence, $100 million. Indoor basketball court where he played with employees who always let him win. Private jets, multiple aircraft. Flew wherever, whenever. Cars, dozens of exotic vehicles. Ferraris, Lamborghinis, Bentleys, boats, yachts. And the strangest part, he started a music career. Recorded country music albums. Used corporate jets to promote them. Spent company money, shareholders' money, to fund his vanity projects. Employees watched this, knew the earnings were fake, watched their CEO spend money like it was unlimited while they cooked books to justify his lifestyle. The psychology was toxic. Scrushy believed he was untouchable, that his success made him special, that rules didn't apply. He told associates, "I built this company. These earnings are my earnings. I deserve this." Let's do the math on where the fake money went. HealthSouth reported $2.7 billion in fake earnings. Real earnings those years, about $1 billion. Reported earnings, $3.7 billion. Difference, $2.7 billion didn't exist. But here's what was real. Scrushy's compensation based on fake numbers, $325 million. Stock sales by Scrushy before collapse, $225 million. He sold stock while knowing earnings were fake. That's securities fraud. Selling shares based on information you know is false. Numbers don't lie. People do. Anyone you know with retirement, savings, and mutual funds, they should watch this. The pattern repeats. Pattern recognition could save thousands. By 2002, cracks appeared. First warning. Bill Owens, former CFO, left HealthSouth in 1997. He knew about the fraud, participated in early stages. For 5 years, stayed quiet. But in 2002, his conscience caught up. He contacted the FBI, told them everything, described the system, named names, provided documents. FBI opened an investigation. Quietly, didn't inform HealthSouth, started gathering evidence. Second warning, HealthSouth's auditor, Ernst & Young, began asking difficult questions. Remember, Ernst & Young audited HealthSouth for years during the fraud. They should have caught it. They were paid millions annually to verify the numbers were accurate. They missed it, or ignored it. But by 2002, even they noticed discrepancies, asset values that didn't match physical inventory, revenue patterns that seemed statistically impossible. They questioned HealthSouth executives, got explanations that didn't quite make sense, pushed harder. HealthSouth accounting staff panicked. If Ernst & Young dug deeper, fraud would surface. They worked overtime, fabricating supporting documents, creating fake invoices, producing false records to satisfy auditor questions. It worked. Ernst & Young signed off on the 2002 financial statements, certified them as accurate. But some Ernst & Young staff weren't satisfied. Information leaked to higher-ups within the firm. Concerns escalated internally. Third warning, stock analysts finally started questioning HealthSouth's consistency. One analyst published a report. HealthSouth's earnings patterns are statistically improbable, industry-facing headwinds, but HRC reports perfect growth. Recommend caution. Market ignored him. Most analysts still rated HealthSouth as strong buy. Scrushy dismissed criticism, told investors, "We're just better managed than competitors, operational excellence." But inside HealthSouth, terror spread. Senior accountants knew the end was coming. Timeline tightened. March 2002. Bill Owens contacted FBI. June 2002. FBI investigation began. September 2002. FBI interviewed former employees. December 2002. Ernst & Young raised serious concerns. January 2003. Investigators requested documents. Scrushy still believed he was safe. Told executives they can't prove anything, stand firm, deny everything. He was wrong. Michael Martin, former CFO, received a call from FBI. They had evidence. They knew about fraud. They offered a deal. Cooperate and get reduced sentence or refuse and face decades in prison. Martin cooperated, signed plea agreement, agreed to testify against Scrushy. Then others followed. Weston Smith, Bill Owens, Aaron Beam. 5 CFOs. All agreed to testify. The machine built on loyalty and fear was collapsing. People who participated in fraud chose saving themselves over protecting Scrushy. By March 2003, investigators had everything. Bank records, accounting documents, witness testimony, audio recordings of meetings where fraud discussed. Scrushy received a call from his attorney. "They're coming tomorrow. Be ready." He thought he could still fight it. Thought he could spin the narrative. Thought his celebrity status would protect him. He had one day of freedom left. March 19th, 2003, 6:47 a.m., FBI agents executed search warrants across HealthSouth facilities, Birmingham headquarters, regional offices, executives' homes. At Scrushy's mansion, agents knocked on the door. 17 bedrooms, indoor basketball court, $100 million of property built on fake earnings. They arrested Richard Scrushy on charges of conspiracy, securities fraud, and wire fraud. That morning, before market opened, HealthSouth issued a statement. Company under investigation for possible accounting irregularities. Stock opened at $14 per share. Within hours, $8. By day's end, $4. Within a week, under $2. $27 billion in market capitalization, erased in days, $27 billion. Shareholders panicked, sold everything. HealthSouth bonds downgraded to junk, credit lines frozen. Banks demanded immediate repayment of loans. The human cost was staggering. The real cost, Diane Bailey's story. Diane Bailey, physical therapist, Birmingham HealthSouth facility, age 52 when the fraud was exposed. She started in 1988, 15 years helping patients recover from strokes, accidents, surgeries. She believed in the mission. The company encouraged employees to invest in the 401k plan. They matched contributions with HealthSouth stock. Diane trusted them. Healthcare company, helping people recover. What could be safer? 15 years of monthly contributions, every paycheck. By early 2003, her retirement account showed $312,000, all HealthSouth stock. She planned to retire at 62, buy a small house near her grandchildren, travel a little, finally rest after 35 years of physically demanding work. March 19th, 2003, fraud exposed, stock collapsed. 1 week later, she checked her account, $12,480. From $312,000 to $12,000, 96% gone in 7 days. She told the Birmingham News, "I did everything right, saved every month, lived below my means, trusted the company I worked for every single day. Now, I'll work till I'm 70, if my back holds out. Maybe longer. My retirement dreams? They're gone." 2025. Update. Diane Bailey is 74 years old. She still works part-time as a therapy aide. She can't afford to fully retire. The money never came back. She lost 8 years of retirement, the years she planned to spend with grandchildren, because 5 CFOs and 1 CEO lied for 7 years. That's one person, one real human being, multiplied by 40,000 employees. That's the real cost of accounting fraud. Not billions on paper. Real people's futures destroyed. Real dreams ended. Real families struggling. Patients suffered too. Hospitals faced cash crisis. Some facilities closed immediately. Patients mid-treatment transferred elsewhere. Disrupted care, disrupted recovery. Cities that relied on HealthSouth for rehabilitation services scrambled to find alternatives. Let's count the final damage. Fake earnings, $2.7 billion. Market cap destroyed, $27 billion. Jobs lost, 9,000 employees laid off, stock value collapse. 98% loss from peak pension funds affected. Estimated $100+ billion in mutual funds held HRC total economic damage, over $30 billion. Perspective. More than the GDP of 40 countries. Enough to fund Medicare for 1 million seniors for a year. More than the entire annual budget of Alabama. One CEO, one company, $30 billion in damage. The legal aftermath lasted years. Scrushy's trial began June 2005. Federal prosecutors charged him with 85 counts. Conspiracy securities, fraud, money laundering, wire fraud. False statements to auditors. Evidence seemed overwhelming. 5 CFOs testified against him. All described Scrushy ordering fraud. All provided details of how system operated. But Scrushy had advantages. Wealth, high-powered attorneys, media strategy. He launched a PR campaign, appeared on local television, claimed innocence, portrayed himself as victim of disloyal employees, said CFOs acted independently without his knowledge. I trusted my finance team, he told reporters. They betrayed me, betrayed shareholders, betrayed everyone. Bold strategy. Blame the people who testified against him. Trial lasted months. Prosecutors presented documents, recordings, testimony from 15 witnesses, all pointing to Scrushy's direct involvement. Defense argued, no smoking gun, no email or recording of Scrushy explicitly ordering fraud. All evidence circumstantial. June 28, 2005. Jury returned verdict. Not guilty on all counts. Stunning. Prosecutors, investigators, observers, nobody expected acquittal. How did he win? Multiple factors. Trial held in Birmingham, Alabama. Scrushy's home, he was local celebrity. Employed thousands. Donated to charities. Before trial, he became a born-again Christian. Joined predominantly black church. Appeared at services. Cultivated community support. Jury of his peers meant Birmingham residents. Some knew people who worked for HealthSouth. Some benefited from his charitable donations. Defense exploited this. Painted Scrushy as generous employer, job creator, pillar of community, victim of vengeful subordinates. It worked. Scrushy walked free. July 2005. Federal case over. But there was a second case. Alabama state prosecutors charged him with bribery. Separate case, unrelated to HealthSouth fraud. Mark allegedly paid Alabama governor $500,000 for seat on state hospital board that regulated HealthSouth facilities. This trial, different venue, different jury, different outcome. June 2006, convicted. Sentenced to 7 years federal prison. Not for the $2.7 billion fraud, for $500,000 in bribes. Justice? Partial. Incomplete. Wrong crime. But at least some accountability. The CFOs who testified? All received reduced sentences. Weston Smith, 3 months prison. Aaron Beam, 3 months prison. Michael Martin, 5 years. Bill Owens, 5 years. Malcolm McVeigh, 5 years. They got time, but less than they would have without cooperation. Meanwhile, HealthSouth survived. Company restructured. New management, cleaned up books, eventually resumed operations, but never recovered fully. Eventually acquired by another company. Name disappeared. Ernst & Young, the auditor who missed $2.7 billion in fraud, paid settlement, $275 million to shareholders. No admission of wrongdoing, just payment. Nobody at Ernst & Young faced criminal charges. If this sounds familiar because you remember Arthur Andersen and Enron, because you remember auditors failing and escaping consequences, pattern's the same. People who cause crisis, mixed accountability. People who enable crisis, minimal accountability. People who pay for crisis, ordinary investors and workers who did nothing wrong. So what does HealthSouth teach? Not just about one corrupt CEO, about systems that allow corruption to flourish, about warning signs ignored, about accountability that fails. Lesson 1. Multiple CFOs equals massive red flag. HealthSouth had 5 CFOs in 7 years. Average company that size? CEO and CFO stay 5 to 10 years minimum. Multiple CFOs and short time signals, serious problems. Let me show you the pattern visually across 4 major accounting frauds. Fraud comparison table. Enron, 2001. First warnings, 1999. Analyst questions. Collapse, December 2001. Gap, 2-year CFO changes, 2 and 3 years. Amount, $74 billion. Outcome, executives jailed WorldCom, 2002. First warnings, 2000. Internal audit concerns. Collapse, July 2002. Gap, 2 years CFO changes. 1, CFO led the fraud. Amount, $11 billion. Outcome, CEO got 25 years. HealthSouth, 2003. First warnings, 1996, CFO number 1 quits. Collapse, March 2003. Gap, 7 years. Longest CFO changes, 5 and 7 years. Record high amount, $2.7 billion. Outcome, CEO acquitted. Valiant Pharma, 2016. First warnings, 2014. Pricing concerns. Collapse, 2016. Gap, 2 years. CFO changes, 2 and 3 years. Amount, $30 billion in market value. Lost outcome, CEO resigned, company restructured. Notice the pattern. Warning signs appear 2 to 7 years before collapse, every single time. CFO turnover in all cases, 2 to 5 changes, always. Regulators investigate after collapse, always too late. Ordinary investors pay the price, always. Timeline never changes, only the names. Now you know what to watch for. You might remember when companies had the same leadership for decades. IBM, General Electric, Procter & Gamble. Same CEO and CFO for 10, 15, 20 years. That stability's mostly gone. Executive turnover is normalized now, but HealthSouth proves why stability still matters, why constant change is often a warning, not progress, either. Company culture is toxic. People are fleeing financial irregularities exist, people resigning rather than participate. Leadership dysfunction, CEO can't work with anyone. If you have investments in companies showing executive turnover, especially finance executives, research why. What to watch. More than one CFO departure in 2 years. No clear explanation for departures. Pursuing other opportunities is vague. Departures during strong earnings periods. Why leave if things are good? How to check this yourself? Go to sec.gov. It's free. It's public. Search the company name. Look for Form 8K filings. These report major events like executive changes. If you see 2 or more CFO changes in 3 years, that's a red flag. Research deeper before investing more. Consider reducing position. Takes 15 minutes. Could save your retirement. Lesson 2. Auditor, silence isn't auditor approval. Ernst & Young audited HealthSouth for years during fraud. Certified financial statements as accurate. Failed to detect $2.7 billion in fake earnings. How? Auditors don't verify every transaction. Sample transactions. Review processes. Trust management representations. If management lies systematically, creates false documents, manipulates records, auditors can miss it. But here's the problem. Auditors are paid by the companies they audit. Conflict of interest, lose the client, lose millions in fees. Not unique. Arthur Andersen and Enron, auditor also consultant, earned more from consulting than auditing Deloitte and Olympus. Missed massive fraud, KPMG and various scandals, repeatedly failed to detect fraud. Until auditors answer to shareholders instead of management, until they're truly independent, they can't be fully trusted to find fraud when it exists. If checking your investments, don't assume audited financials means accurate financials. Lesson 3. Celebrity CEOs are higher risk. Richard Scrushy was celebrity. Magazine covers, public appearances, country music albums. Pattern exists. CEO focused on personal brand rather than company operations is red flag. Why? Celebrity CEOs often believe their own hype, think they're special. Rules don't apply. Examples: Elizabeth Holmes, Theranos, magazine covers, celebrity status, massive fraud. Adam Newman, WeWork, charismatic founder, company nearly collapsed. Elon Musk, Twitter, controversial management, erratic decisions. Not saying all celebrity CEOs are fraudulent. Saying celebrity status sometimes correlates with ego, lack of accountability, risky behavior. If you own stock in company with celebrity CEO, watch carefully. Make sure board has real oversight. Make sure CFO is strong, independent voice. Celebrity isn't competence. How to protect yourself. 3 things you can do this week. You've learned the warning signs. Now here's how to actually use them. Action 1, check your healthcare holdings log into your 401k or IRA account today. Look for healthcare sector funds or individual stocks. Write down the names. Common healthcare funds, Vanguard Healthcare Fund Fidelity, Select Healthcare T, Rowe Price Health Sciences. Any fund with health or medical in the name, individual healthcare stocks to check. Hospital companies like HCA Healthcare, Tenet, Universal Health Services, rehabilitation companies. Medical device manufacturers, write them down. You need to know what you own. Action 2, monitor, CFO changes, go to section. Government, it's free, public information. Type the company name in the search box. Look for Form 8 K filings. These report major events, including executive changes. If any company you own shows 2 or more CFO changes in 3 years, that's a red flag. Time to research deeper, maybe reduce your position. Action 3, track financial reporting. Annual reports, Form 10K, are due 90 days after fiscal year ends. Quarterly reports, Form 10Q, are due 45 days after quarter ends. If a company delays filing, warning sign. HealthSouth delayed reports in 2002, 12 months before collapse. You can set up free email alerts on sec.gov. Get notified when companies file reports. Where to get information? All free, sec.gov for official filings. Yahoo Finance for basic company information. Google company name CFO change once per quarter. Takes 15 minutes every 3 months. Could save your retirement. I check these things monthly for the companies I'm watching. You should check quarterly for anything you own. This pattern isn't finished. Right now, January 2025, the healthcare sector faces the same pressures that created HealthSouth. Medicare reimbursement cuts, hospitals earning less per patient, rising competition, more facilities, fighting for fewer dollars. Wall Street expectations must show growth every quarter. Same formula, same pressures, same temptations. I'm watching for 3 specific warning signs in major healthcare companies. Warning sign 1, CFO turnover. If any Fortune 500 healthcare company shows 2 or more CFO changes within 3 years, red flag. Check Form 8, K filings on sec.gov quarterly. Warning sign 2, delayed financial reports. Form 10K annual reports due 90 days after fiscal year. Form 10 Q quarterly reports due 45 days after quarter. If any major healthcare company delays by more than 30 days, warning sign. HealthSouth delayed in 2002. Collapsed 12 months later. Warning sign 3, unusual margin. Expansion. If profit margins grow 5% or more while competitors stay flat or decline, investigate why. Either they've found genuine efficiency or they're manipulating numbers. Check quarterly earnings reports. Companies to monitor. Major healthcare services companies, HCA Healthcare, Tenet Healthcare, Universal Health Services. I'm not saying these companies are committing fraud. I'm saying these are the types of companies where pressure exists, where patterns could develop, where you should watch carefully if you own their stock. Check their SEC filings quarterly. Compare their performance to industry peers. Look for the warning signs. Timeline, pattern. HealthSouth, first warnings 1996, collapse 2003, 7-year gap. Valent Pharmaceuticals, first warnings 2014, collapse 2016, 2-year gap. Pattern says major healthcare accounting scandals appear every 7 to 10 years. HealthSouth collapsed 2003, Valent 2016. We're overdue. If pattern holds, and it always does, we'll see another major healthcare accounting scandal by 2027 to 2029. I'm checking SEC filings monthly for the companies I listed, watching for CFO changes, watching for delayed reports, watching for margin anomalies. When warning signs appear, and history says they will, I'll cover it. You should watch too, because it will happen. Always does. Here's uncomfortable truth. System that enabled HealthSouth hasn't fundamentally changed. Wall Street still demands consistent growth every quarter. CEOs still face enormous pressure to meet expectations. Auditors still paid by companies they audit. Boards still sometimes defer to dominant CEOs. Different names, different companies, same incentives creating fraud. Until we change how executive compensation works, until it's based on long-term sustainable performance instead of quarterly earnings, until auditors are truly independent, until boards have real power to challenge CEOs, pattern will repeat. Because fraud isn't about individual bad actors. It's about systems that reward deception and punish honesty. March 19th, 2003. 6:47 a.m. FBI agents knocked on mansion door. Richard Scrushy arrested. 17 bedrooms, indoor basketball court. $100 million of property built on fake earnings. Within days, stock collapsed. Within months, jobs disappeared. Within years, company name erased from American business landscape. What happened to the $2.7 billion? Never existed. Fake numbers on paper. Illusion of success. Fiction told so often everyone believed it became real. But the damage was real. $27 billion in market value destroyed. 9,000 jobs lost. 40,000 employees' retirement savings devastated. Patients' care disrupted. And Scrushy served 5 years for bribery, released 2012, never convicted for the fraud itself. 5 CFOs who participated, prison time ranging from 3 months to 5 years, all released, all moved on. Ernst & Young, the auditor, paid settlement, still operates, still audits major companies. But here's what nobody admits. System that created HealthSouth still exists. Corporate culture prioritizing growth over truth. Wall Street demanding impossible consistency. Auditors with conflicts of interest. Boards deferring to powerful CEOs. Next HealthSouth already in development. Different industry maybe. Different name certainly. Same dynamics. I'll be watching healthcare sector CFO turnover. Specifically, companies showing executive changes while reporting unusual consistency. If 3 major healthcare companies experience CFO changes in next 12 months while maintaining perfect earnings growth, we're stage 2. Pattern says every 7 to 10 years, major accounting fraud surfaces in healthcare sector. HealthSouth collapsed 2003. Valent Pharmaceuticals 2016. We're due. Track these indicators monthly. 1. CFO turnover. Check sec.gov for Form 8. K-Filings Healthcare Services Companies, HCA Healthcare, Tenet Healthcare, Universal Health Services. If 2 or more CFO changes in 3 years, red flag 2. Earnings growth anomalies. Compare companies' profit margins to industry average on Yahoo Finance. If exceeding peers by more than 20% without clear explanation, investigate 3. Delayed SEC filings form. 10K due 90 days after fiscal year. Form 10Q due 45 days after quarter delays over 30 days. Warning sign 4. Auditor changes. Sudden auditor switches without clear reason. Concern, check annual reports. For auditor, name changes. When 2 or more appear in same company, warning bells should ring. I'm checking these quarterly for major healthcare companies. Takes 15 minutes. You should too if you own healthcare stocks or funds. Share this with friends checking their quarterly retirement statements. And these warning signs could protect their savings before the next collapse, because it will happen again. Always does.